Okay, hi guys. This is quite an impromptu video on CapitaLand Group REITs and Business Trust comparison dated 12 January 2025. This is done with permission from Vince from retirement. Alright, and this link will be in the comment section below. Alright, so it reads below is a comparison using data from comparison data on REITs data page. Right, so this is a clickable link. The most favorable data is marked in blue and given a +1 score, least favorable in red and -1 score. The highest score in each category determines the winner. Note that this is a simple comparison without weightage assigned to each figure, and this may not be an apple-apple comparison as each focuses on different sector or different geographical location. So what he's trying to say is that he's just doing a very simple comparison. The best figure will be given +1, the lousiest one is -1, then the winner is the one with the most higher score, right? Obviously, this is not this is a simplified way lah. So a more complex or better way would be to assign a weightage to it lah. But that will be super complicated, right? So that we are not doing that in this video. And of course, different REITs, because we are looking at all of CapitaLand's REITs or business trust, right? So different sectors like, for example, industrial, retail, and office should have different valuations, right? And of course, if you are different location like China, India, or Singapore, or US, right? Again, different valuations apply, right? So this is a simplified comparison. It shouldn't be the way that you go about doing your final investment decisions. It should be just one of the parameters to look at, right? So anyway, again, this unweighted ranking, again, just to stress, this is not financial advice, right? Please do your own due diligence in terms of data and decision making. Alright, please always check the original source of data before you do investments, for example from the annual report or the presentation slides. Alright, yeah, so in terms of fundamentals, Escort is the best, followed by CICT. In terms of fundamentals, Ascenders is the best followed by CICT, followed by Escort. Then China and India are not doing so well. Valuations wise, that means who is cheapest, right? Escort is the cheapest in terms of valuations. Ascenders is the second and China is the third. Then CICT and India looks expensive, right? Right, so let's look at the listing date, right? CICT is the first REIT in Singapore in July 2002, right? Followed by Ascenders. I believe Ascenders is the second REIT in Singapore, right? Then you see 4 or 5 years later, Escort and China came up, then India, right? So business mode, Ascenders, China Trust and Integrated Commercial Trust are all REITs, whereas Escort is a stapled security, which means there's a REIT and business trust component. You can watch my video on Escort to know more about this. And India is actually just a business trust, right? So it doesn't have to pay out 90%. Right, so major sector, Ascenders is office, Escort is hospitality, China is retail, India is office, and Integrated Commercial Trust is retail, right? So Singapore, obviously Ascenders and CICT, right? China and India are obviously in their names are China, India, and Escort is actually more on United States, right? They all pay dividends semi-annually, right? Unit price, won't talk about it. Price over NAV, the most expensive one is Ascenders, because 1.13 means that for $1 worth of Ascenders, right? Let's say you strip Ascenders down and sell off all its building, pay off all its debts, whatever is left over is $1 per share. You are actually paying $1.13 for that, right? So you are paying a premium for Ascenders REIT shares, right? The rest are actually below 1, which means that supposedly they are cheap, right? China Trust is the cheapest at 62 cents for $1 of CapitaLand China Trust, right? Dividend yield wise, you can see the highest is again CapitaLand China Trust, so 8.23. This trailing 12-month dividend yield means that looking at the past 12 months, right? So this doesn't tell us what is the yield is moving forward, right? So moving forward, we have to anticipate lah, because the data is not out yet, right? So the most expensive is CICT, right? So 5.61%, right? So market cap wise, CICT is the biggest. I'm a little bit surprised the smallest is actually CapitaLand China Trust, right? Yeah, I didn't know CapitaLand India Trust was bigger. I always had the impression that CapitaLand China Trust was bigger, right? Primarily because number one is older. Yeah, but anyway, yeah. So smallest REIT for CapitaLand apparently is China Trust, right? So this one I won't talk about it, alright? Otherwise the video will be too long, so I don't want to talk about everything, right? Just this one, just you see all red color, so we just talk about this a little bit. So sometimes there's a reason why this matrix look cheap lah, right? So why dividend look high and the price over NAV look low is primarily one of the reasons could be these things. Number one, occupancy is the lowest, right? You can see across the board all above 90% except this one, right? Then you can see that weighted average lease expiry, so 1.8 years, and this one has concerns about the tenants not even renewing. So that means to say, generally 1.8 years is the average business going to expire is lease, and they may have to renegotiate rents, right? So some businesses may just give up, or the rents may go down, especially for the logistics and business park sites which have occupancy issues, and quite serious ones at that, right? So 40% in the next 4 years. How's annual lease expiry? Yeah, so 40% of the lease is expiring in the next 4 years, and this is the average land use lease expiry. So this one is the concern that China REITs have generally, that if you look at the rest, the land use timing is quite high. Yeah, you see India has 95.9 years left, right? So yeah, 22.7 years means that generally, especially their mall side, right, they have around that kind of timeline before their rights to the land is expired. So it's like HDB, after 99 years the government will take that, right? So after 22.7 years on average, right, their land lease is up. That means to say they have to see whether the government want to let them renegotiate an extension to the land use or not. And if they have to renegotiate the also how much they have to pay lah. So how much they have to pay is one problem, and secondly, whether or not the extension will be afforded to them is the second problem, right? So these are all big question marks, and one of the reasons why this CLCT, right, has always been trading at higher, for example, dividend yield than maybe CICT, right? Other reasons are possibly because this one the dividend has been going down lah, and this one the dividend has been going up, so the price also shifts to reflect that, right? So yeah, right. Adjusted interest coverage ratio, again, we remind ourselves, includes the amount that we pay for perpetual securities. So this is a better sense of what is going on than just gearing ratio, which only covers its debt without its perpetual securities, right? So adjusted interest coverage ratio is good for Ascendas REIT, 3.5, right, the strongest among them. The rest all around 3. India is surprisingly low at 2.6. I'm not very sure. I don't really cover India, but cost of debt for India is also very high at 6%. I'm not sure why also, right? So the rest are, I mean, I guess not very surprising, right? It's around the cost of debt for, yeah, this is Singapore based and Singapore based, that's why I guess they're quite close, right? Escort US, yeah, Escort is surprisingly low at 3%, right? And then China is 3.6%. This one is disappointing because I expected the last results, this one to go lower, because they shift from Singapore to Chinese yuan, which is getting cheaper. The cost of debt for Chinese yuan is getting cheaper, but don't know why these things still not going down. Yeah. Gearing ratio is more or less 40% for all. However, you should probably look at their perpetual securities. So he has very good numbers like that, which is hybrid securities over debt plus hybrid, which means to say this is perpetual securities over their total debt, right? So in terms of percentage wise, you can see Escort has a lot of debt, or at least 11.6% of hidden debt, right, that's not reflected in this gearing ratio. So this one is a bit misleading because this one don't include their perpetual securities, right? So you have to be careful with this positive number, right? So Escort has 11.6% high-risk securities over their total debt, right? So this one is the more worrying case, right, if you want to look at their total debt, right? India and CICT has 0 perpetual securities, right? So that's a good thing. The rest, I don't think, yeah, this one hopefully is a good thing, right? If their debt matures faster, right, maybe they can get lower rates for this one, CapitaLand China Trust, right? I don't think I'll talk about this. Yeah. Yeah. So distribution from management fees paid units, right? So I think this is interesting. So CapitaLand Ascendas REIT 2.7% of the management fees paid unit. Escort is 10.7%. China is 14.1%. India is 10.8%. CICT is 6.2%. Yeah, so CapitaLand China Trust is the most dilutive in terms of they have to produce more shares to pay the management. Alright, so generally this one is no good because number one, it artificially inflates your DPU, your dividends currently, but in the future it dilutes your DPU because when you have dividends you have to share it over a larger base, right? So because you keep creating new shares to pay management, in the future the dividends need to be divided over a larger share base, so your dividends keep getting lesser. And also the other way to look at it is that if you had, instead of paying these fees in units, right, you pay in cash, right, that means your cash currently will be lower. That means you can pay out less money for dividends, so your actual dividends may be actually lower than the 8+% that was discussed earlier, right? So just now you say 8.23%, right? But if you make it such that it's comparable with the other REITs, the amount of management fee paid in units, right, then this may be slightly lower, right? I don't think it's that significant, but the difference, right, not very significant, but just to take note, alright. So a bit higher distribution from management fees paid in units, right? Income support generally is not a good thing, but you can see it's not very relevant from this CapitaLand Ascendas, right? So distribution from divestment also, they don't really sell too much, right? Yeah, retention, yeah, only India retains some significant amount. Yeah, this matrix is quite similar to the in front, right? Distribution of perpetual securities. Why this one is higher is because they have more perpetual securities, as can be seen from this one, right? 11.6%. So that's why this one is a bit higher at 5.7%. Right. We look at DPU from operations, right? Generally not a good thing, right? This is not just DPU, this is DPU from their core business, right? So the only good one look like India, right? So I guess that's why India is a bit expensive, right? So because their DPU from operations is an uptrend, right? Everyone else is downtrend, Ascendas is flat, right? So yeah, the performance for all the CapitaLand REITs aren't very good, Okay, NAV per unit, yeah, for 10 years at least Ascendas is not bad, CICT is not bad, it's uptrend. India is not bad, China and Escort are not faring so well. Alright, so the rest I won't talk about it. Yeah, operating distributable income over management fees is all downtrend. So that's quite bad. So what this means is that operating distributable income is the amount of money from operations that they can distribute as DPU, right? Then divide by management fee. So if downtrend, it means either operating distributable income is dropping, or it means your management fees is going up, or both is happening. So when you see all this downtrend, it means it's not a good thing for the CapitaLand REITs, right? So if we look at the price range, what is cheap is in blue, right? So current percentile 12.5% means that the current price is closer to the low, the 52-week low, right? And you can see India is a little bit higher than average, right? So yeah, the average is 1.10, the current is 1.08. Yeah, I'm not sure how they get 54% here. Yeah, but it should roughly reflect the fact that it's closer to the high than the low, right? So yeah, I'll check with Vince how he did this calculation. I'm not very sure. Yeah, but generally what this means is that it's closer to the high if it's red color, and it's closer to the low if it's blue color, right? So this one is Escort, closer to the low than the high, right? So 88 cents, yeah, quite close to the low of 3 years, right? So this is a 3 years data. And CICT, even though it's quite close to the average, right? You see it's quite close. You see 50 percentile means that it's close to the average, right? 5 years data, the cheapest looks like Ascendas again, most expensive look like CICT, but I would say that it's still below the average, right? Because once this thing is below 50% means it's closer to the lower end, right? So still looks cheap even though it's the more expensive of the rest, right? So again, 10-year data is China that is the cheapest, right? So it will be close to the low, 62 cents. Currently is 73 cents, right? Then CICT looks the most expensive. So if we look at this matrix, look like Ascendus is the cheapest, right? Dividend yield, okay, average, not going to talk about it. This 1 year lah, roughly average. 3 years wise, average, except this one, which is Escort. So Escort is on the higher end, right? So the dividend yield is currently higher than it normally trades over the last 3 years, right? One standard deviation is quite significant, right? Because 2 standard deviation is very significant. One standard deviation is somewhat significant, right? So who is cheap according to 5 years? Ascendus and Escort, right? So 1 ST above the average. 10 years data is Escort and China, right? Price over NAV, again, average, I won't talk about it over the 1 year. -1 standard deviation, this one is cheaper, right? So yeah, it's slightly cheaper than average lah, right? So you can see generally cheaper than average. Yeah, generally 1 standard deviation cheaper than average. Ascendus, Escort and China, right? Everything is, yeah, because last 10 years I think is because the last 10 years has been good to REITs, right? So generally everything looks cheap as opposed to the last 10 years results, right? Yeah, so with that, that's the end of the walkthrough, right? You can click the link below if you want to look at the data steps in more detail, right? Please note none of this is financial advice, and thank you for listening.